Welcome to this episode number 41 of your next trade called today bonds only. So as we have seen over the last few weeks, this market is very much driven by bonds only. Now we still got the US 10 years at 4.5% and above, reached 4.7% over the week, came back, but clearly most asset classes will be following bonds. So we had a better PCE on Friday, so inflation is not coming down, but it's coming from very high level. And slowly but surely we are getting closer to the 2% target from the Fed. But still, bonds yields are going to stay higher for longer, and that is having a repercussion across asset classes. So in the month of September, as usual, the seasonality is pretty bad. So we had the S&P, the Nasdaq that were roughly down 3 to 5%. TLTs, bonds really smashed over the months. Similar picture. If you look at commodities, gold really struggled at the end of this week with the gold being down 4% for the week. So really, bonds being higher for longer is suffering many assets. So let's start with the week-to-date asset performances, starting here with the stocks. So stocks are roughly flat to small down for the week, flat for the Nasdaq, small down for the S&P. So we managed to recover 1 to 2% from Thursday, let's say 3 hours before the close, and Friday. But what is really interesting is the gold down 4%. So with higher rates, higher yields, and the Fed clearly saying we're going to stay there for quite a long time. Now the market is saying, okay, we stay there for a long time. Dollar is pretty strong, higher yields. That is not helping the silver and the gold. So really, gold sold off the whole week. We ended up at 1850. So clearly, interesting picture for the people who so far were playing gold as a safe haven. Looking at the week-to-date industry performance, this is another interesting one. So we got the gold miner, we got the silver, we got the gold that are down similar. All the three are the same. But we got utilities really suffered for the week. So that will be for the XLU. We're going to be discussing that later. But interesting to see those sectors that are impacted by higher yields that are really struggling. Retail pretty good, so that is a space that we want to watch out, which is retail, consumer discretionary. Why? Because going forward, I think the US consumer, as I've been saying, starting from October, will start to struggle. But for the week, we got two okay earnings. The first one was from Costco, which came with better numbers. And then we got Nike, with Nike saying that they are selling some of their inventory. So inventories are coming down. So a bit of hope coming from here. But as you can see, S&P here, so in between the plus and the minus. So quite a divergence between the winners and the losers. And if you look at from Thursday onwards, especially on Thursday, the biggest winners from this rally or this bounce after an oversold situation were mostly the dodgy tech companies, meaning the companies are not making money, and the highly oversold stocks. What about the week-to-date sector performance? So clearly, utilities, the big underperformers for the week, down 7%. Other end of the spectrum, we get the XLE oil doing pretty well, with WTI still above $90. So I want to go now into the rates, because really this market, it's a bonds-only market. We are all watching how the 10 years, how the 2 years, how the 5 years, how the 30 years have been trading. And as you can see, for the US 10 years, we ended up at 457. So we are up for the week. But what is interesting is this part of this tab, which is the 10 years versus the 2. So we have for the last 18 months an inverted yield curve, which has been a very good indicator. A very good leading indicator for the market struggling, and more importantly for the US economy to go into recession. Now, what we had over the last 2 weeks or so is a steepening of this yield curve. This is what we call the bear steepening. And what is happening is mostly the 10 years have been moving, where the 2 years have been flattish from one week to another. So bear steepening, that very much is a even better indicator that we're going to get closer to a recession in the next few months. So something that we flagged again and again, we were waiting for this bear steepening to be happening. Now we went quickly, as you can see here, on this 10 versus the 2. What about the Fed expectations through the Fed fund rates? Not much of a change between Friday and last week. If you look at December, it's more or less the same, December 2023. And if you look at December 2024, it's more or less the same. So for those of you who are not very familiar with the Fed fund rates, it's the way of understanding what the Fed funds will be in the future. So for the time being, they are at 5.33%. So if you compare this 5.33 versus the level of December, which is 4.72, so roughly you have 60 bips difference. That means the market is expecting between now and December 2024 the Fed to be cutting rates by, or the Fed fund rates by 60 bips. So between 2 and 3 25 bips cuts. What about the VIX? VIX at 16.66. We went into the 19-20%, so pretty high. The steepening, it is still the term structure of the VIX is more or less the same. So we had a bit of a selling of volatility from end of the afternoon of Thursday to Friday, where as usual the products that are based on selling volatility have been coming back into the market. Remember, as I said, as I flagged 2 weeks ago, when volatility was at 13%, that was not a good entry point to be selling volatility. I would like now to go into technical analysis, price action, and as we have been at the end of this month, now that we are going into October, I'll be using a monthly setup, and this is starting with the S&P future. So as you can see, the candle is not very good for the month of September, so that's the negative. On the positive, you can argue that we have been getting closer to this not this range, but this trend on the way up. We have been changing the yellow bands, which are the color from the JP Morgan fund that was rolled as of yesterday. So now we get the new, so that's the sell of the call, and that's the put spread at 40.55 and 34.20. It feels very much to me that if you look at volumes, if you look at a lot of indicators, we will have to go into the 4200 first. So that means we're going to be breaking this trend going down. If you look at the Nasdaq now, the picture is the same. We had 3-4 good months, and over the last couple of months we have been consolidating. Looking at the Russell trading sideways for the last year or so, no real direction, but what is pretty much clear is the Russell, which is small and mid companies, have been really underperforming the overall market. Why? Because the S&P is mostly driven by 7 to 8 names, so you know those fantastic 7. So those fantastic 7s are making the market pretty good for the year, up roughly 10%. But if you go into details, if you drill a bit further, you will see that roughly 90% of the S&P is struggling. So let's look now at the FANG of this world versus the S&P. Same, we are consolidating. No big surprise, the market is waiting for end of October earnings coming. So the earnings season will be starting in 10 to 15 days with JP Morgan. And I'm interested in JP Morgan. So look at that chart. This is a monthly chart. It tells me that the price action going forward is not looking great. So we have been breaking this trend, this uptrend. So months has not been really good for JP Morgan. You can say it's only flattish versus the market, but pretty much broken trend. So if you want to believe like me, like JP Morgan is really a leading indicator of the US economy, that is not a good sign. What about oil? Oil, we are above the 82. If you look a bit more into details, that is something that we discussed on the Discord community for months on months, and we discussed even more this week, which is the backwardation of the oil market, which is driving the market higher. And as long as you get this imbalance between supply and demand due to the Russians and the Saudis cutting production, you'll have oil at least staying at very high level. What about the copper? Copper is still holding this trend, but we are getting closer of breaking this trend. So I will be keeping an eye. Gold, as I said, 1450, sorry, important level, but really the momentum at the end of this week was pretty bad. So you can argue that there is a lot of rebalancing at the end of the month, at the end of the quarter, as we have seen on Thursday and Friday, and gold was very weakish in the last 5 hours of the trading session. Again, something to keep in mind. Euro dollar trend is still the same. Now we are at 105, so we tested a bit below 105 on Friday, or I think it was on Thursday, and we bounced back. But the picture for the dollar yen is still the same, which is the weakening of the Japanese yen. As long as the US 10 years is going to be at this level, and is pretty much, that makes, the 10 years in the US is at 450, 460, when the Japanese 10 years is at 0.7%. So you understand why the Japanese yen is struggling. A bit of Europe looking at the stock 600, consolidating, but not great. We have been making new lows after new lows. DAX is the same. It feels very much like Q4 could be a bit of a problem. So I want to go back now into what has been happening for the week. So it's bonds, and bonds. So looking first at the S&P. So S&P really we have been down 70 bips to 80 bips, so not much. But Wednesday was a bad session. We managed to bounce back at the end of session on Thursday, but no real direction. 43.29 on the close, roughly. I think the 4200 is the big level. If you look at volume profile, if you look at trends, feels very much like we will have to go to this level and test this level. So correlation, this is the same chart, but using 5 more days, looking at the S&P futures and the T-Not futures, so that would be for the 10 years futures. You see the correlation between, in blue, the S&P and the 10 years. So more or less, if you are trading any asset classes, you are in reality trading bonds. So no matter what, it's funny when stocks traders are saying these days, oh, I only care about EPS, I only care about, multiples, and I don't care about macro. You should be caring about macro, because these days it's all about macro. It's all about, how these 10 years, how those bonds are going to be trading. So we have been talking for months and months about this inflation. As I said, PCE was a bit better, but the market is now pricing, the Fed to be higher for longer, and that has been confirmed with the move that was done for the gold for this week. If you look at equities, we're going to have this next catalyst, which are the earnings season, as I said, starting with JP Morgan and the banks in 2 weeks' time. My view is still the same. Every session I'm repeating the same, which is the US consumer is struggling and will start to struggle even more. If you look at the GDP revisions, most of the revisions on the way down were coming from the consumption. Why? Because so far in Q1 and Q2, the GDP was held very much by the deficits, by the government, but now the market is saying, there is a limit to deficit, so you need to be careful. Remember that there is this US presidential election coming, and that means one of the biggest topics is going to be the US deficit, and can you carry on putting a lot of bonds into the market, a lot of supply. Finally, looking at this chart, so that will be, this one is XLU, this one is XLE, so this one is utilities, this one is oil or energy. So that's the energy, and everything was flattish or doing the same. So out of the 11 sectors of the S&P, 9 of the 11 sectors were doing more or less pretty much the same. XLE is still outperforming because it's following oil. And on the other end of the spectrum, from Tuesday onwards, we started to see XLU completely diverging from the rest of the pack. So XLU down 7%, impacted obviously by higher yields, and this is where you start to see divergence between sectors. What about the catalyst going forward? So we're gonna have a lot of ISM PMI. So we start on Monday with the ISM manufacturing in the US and the European manufacturing PMIs. In terms of services, that will be for Wednesday. We had manufacturing has been struggling for months. That is true for the US, that is true for Europe, that is true for China, and services so far have been holding pretty well. What we have seen from manufacturing over the last couple of months in Europe, in the US, and in China, it's kind of staying at the same level, consolidating. On the other end of the spectrum, services are slowly but surely ticking lower. If you've been doing the 4x4, if you've been following those videos, you do know that services will follow the manufacturing. The reason is because all along the value chain, you'll have different services. So when manufacturing is struggling, services will follow. So we will be obviously looking at the details of the manufacturing and the services, looking at the prices, because the market is saying, is it PC coming down? Are we pricing too much of higher yields from the central banks? I don't think this is only inflation. I think there is a lot of case of if you have been using 5-10% deficit. So if you look at Europe now, we are expecting in Italy, for France, for instance, 5% GDP, debt to GDP for the next 2 to 3 years. In the US, this is the same, 5 to 10%. To finance higher deficit, you need to print a lot of money. Not to print, but you need the treasuries to come to the market, and that means you are putting a lot of paper in the market. So that means to meet this supply, the demand needs to have higher yields. So that is what is happening. So in terms of macro, NFP on Friday, important number as well, because you do know the dual mandate of the Fed, and one of the mandate is obviously full employment. So NFP on Friday. A bit of earnings, so we got 2 to 3, not that many, but I think what is important is here, if you trade like me, special situations, for instance, we have many spin-offs on Monday and Wednesday. So on Monday we got 4, so we got 3 in the US and 1 in Finland. We got 1 on Wednesday in Switzerland. So spin-off, those are very nice special situation. The reason is if you want to go long or short a stock, most of the time what you would like to have is a catalyst, and by definition a spin-off is a natural catalyst. So for those of you who are watching this weekend, you get 2 days left to look at those different spin-offs. We are talking DHR, Kellogg's, and we are going Mark, and we are going Sempo in Finland, and Novartis on Wednesday. We got some, and more than some, Fed speakers. So we got Powell on Monday, Mester on Tuesday, and some others. So PMIs, ISM, Fed speakers, NFP. We got the seasonality. Why is seasonality important? So here we are looking at October, November, December. So we just ended up this really bad month that was pretty flagged by everyone, even me, telling you, September is really, really bad. Normally, what happens if you look at the seasonality of the S&P, we are normally making new lows at the start of October, and then we go up. Okay, so that's the normal situation. My view is, because I want to be a bit contrary for this year, is I think now actually the macro will kick in. And the bad macro numbers, we are talking the services, we are talking the US retailers, we are talking the US consumption, will be an issue. And that means for the next 3 to 6 months, the numbers in the US will be not as good as before. So I think expecting a rally, might be wrong again, but I think the next earnings season is not going to be enough to save the market. So that is for me for the seasonality. So I don't know if it's 1.8. That should be actually around this number. So maybe check this one. But in terms of seasonality, normally it's good going forward, but when it's bad, it's pretty bad. Finally, in terms of ID generation, many even stocks traders and macro traders have been looking at not only the yields, the rates, but more importantly, how the spreads have been doing, the credit spreads, meaning, how the bonds have been trading versus the treasuries. So if we look here, you can be using Fred and looking at this triple B spreads. As you can see, the spread have been pretty flattish recently. So the credit market for most of the spreads, even the high yield, have not been moving that much. Again, I think I already discussed that before. When you start to talk with people in the repo market, with bond traders, they will tell you so far credit have been okay. It has been, bonds have been selling, but not that much of spreads widening. And they are expecting actually spreads to be widening from Q2 2024 to H2 2024. So in the next 6 to 9 months. So if you want to believe that the market is still looking forward, I think there are some problems looking for the credit spreads. So you can be using tons of ETFs, but if you're trading stocks, I strongly advise you to be looking at how the bonds of the different companies you'll be looking at are trading. So you'll be looking at the debt distribution, if there is refinancing in the next couple of years, 3 years, and as I said, how bonds are trading recently. So that would be for my trades looking forward. A lot of macro seasonality positive going forward after catastrophic September. So this is it for me today. If you have questions, if you want to know more about the 4x4 video series and or the mentoring, you can send me an email at greg@duponttrading.com. If you want to join our trading community on Discord, this is for free. There are 2-3 channels that are for free. There are 20 more channels for people who have done the mentoring or people who did the 4x4 video series in the past. So this is it for me today. Again, good seasonality, even if I don't think it's gonna be helpful enough. But a lot of macro going with the PMI services and the PMI manufacturing. This is it for me for the week. See you next week. Bye bye.